There's a tax tsunami coming that's going to wipe out middle-class wealth, but most people are sleepwalking into financial disaster. What I'm about to tell you isn't political rhetoric or doomsday predictions. This is mathematical certainty based on government debt levels, demographic trends, and policy changes already in motion. And if you don't act before 2027, you're going to watch a significant portion of your wealth disappear into government coffers. I don't care if this makes you uncomfortable. I care about protecting your financial future. And right now, if you're not actively planning for what's coming, you're planning to give the government money you could have legally kept. This isn't about tax evasion or exotic offshore schemes. This is about understanding the rules of the game and positioning yourself accordingly before those rules change permanently. The wealthy are already moving. They're restructuring their investments, relocating their businesses, and repositioning their assets. Meanwhile, the middle class is sitting there completely oblivious to what's about to hit them. They're focused on their daily expenses, while a much larger threat is building in the background. And by the time they realize what's happening, it will be too late to protect themselves. Let me be crystal clear about what we're facing. Federal debt has exploded to levels that would have been unthinkable 20 years ago. We're talking about over $30 trillion in debt, and that number is growing by trillions every single year. Social Security and Medicare are facing massive shortfalls as baby boomers retire in record numbers. State and local governments have unfunded pension liabilities that dwarf their annual budgets. This isn't sustainable. It's mathematically impossible. And when governments can't cut spending, which they never do, they raise taxes. That's not opinion. That's history. Every government that has faced this level of fiscal pressure has chosen to extract more revenue from its citizens rather than reduce its obligations. And the United States is not going to be different, but here's what makes this particularly dangerous for you. The politicians know they can't raise taxes on everyone at once. That would cause a revolution. So they're going to target specific groups. And if you have any wealth at all, if you've saved money, if you own a house, if you have retirement accounts, you're in their crosshairs. They're going to call it fairness. They're going to say the wealthy need to pay their fair share. But here's the reality. The truly wealthy have already moved their money. They've structured their finances to minimize tax exposure. They've diversified geographically. They've converted assets into tax advantage forms. The people who are going to get crushed are the people who think they're not wealthy enough to worry about tax planning. The tax changes that are coming aren't just about raising rates. They're about fundamentally changing how different types of income and assets are taxed. Capital gains rates that have been stable for decades are going to change. Retirement account rules that people have planned their entire financial lives around are going to change. Estate tax exemptions that families have structured their wealth transfers around are going to change. And the timeline for these changes is much shorter than most people realize. Many of the most significant changes are already scheduled to take effect in 2026 and 2027. That means you have less than 3 years to position yourself properly. After that, your options become much more limited and much more expensive. Let me walk you through what's already been proposed and what's likely to happen. First, capital gains tax rates are almost certainly going up. The current maximum rate of 20% for long-term capital gains could easily double. Think about that for a second. If you have a stock portfolio worth $500,000 and you need to sell it, the difference between a 20% tax rate and a 40% tax rate is $100,000. That's real money. That's retirement money. But it gets worse. There are proposals to eliminate the step-up in basis for inherited assets. This is a technical change that most people don't understand, but it could devastate middle-class families. Currently, when you inherit assets, you get them at their current market value for tax purposes. That means if your parents bought a house for $50,000 that's now worth $500,000, you inherit it at the $500,000 basis. But if they eliminate step-up in basis, you'll owe capital gains taxes on $450,000 of appreciation that you never benefited from. The retirement account changes are equally dangerous. There are serious proposals to limit the amount you can accumulate in retirement accounts. They want to cap total retirement account values at around $3 million. Anything above that would be subject to immediate taxation. Now, $3 million might sound like a lot, but if you're consistently contributing to retirement accounts for 30 or 40 years and getting reasonable returns, you could easily exceed that limit. But here's the really insidious part. They're also talking about eliminating Roth conversions for high earners. Right now, you can convert traditional IRA money to Roth IRA money, pay taxes on the conversion, and then enjoy tax-free growth forever. This is one of the most powerful wealth-building tools available, and they want to eliminate it for anyone making over a certain income level. The estate tax changes are going to hit families that never considered themselves wealthy. The current estate tax exemption is over $12 million per person, which means most families don't worry about it. But that exemption is scheduled to drop by half in 2026, and there are proposals to reduce it even further. Suddenly, families with houses, retirement accounts, and modest investment portfolios are going to find themselves subject to estate taxes. And don't think you're safe just because you live in a low-tax state. State governments are facing their own fiscal crises, and they're going to raise taxes too. States like Texas and Florida that currently have no income tax are going to face enormous pressure to implement them. States that already have income taxes are going to raise them significantly. This brings me to one of the most important strategies you need to understand: geographic arbitrage. Where you live matters more than ever when it comes to taxes. The difference between living in a high-tax state like California or New York and a low-tax state like Texas or Tennessee isn't just a few percentage points anymore. We're talking about differences that can cost you hundreds of thousands of dollars over your lifetime. But geographic arbitrage isn't just about state income taxes. It's about property taxes, sales taxes, estate taxes, and dozens of other taxes that vary dramatically by location. $1 million house in New Jersey might cost you $30,000 a year in property taxes. The same house in Texas might cost you $15,000. Over 20 years, that's $300,000 in savings just from choosing the right location. The wealthy understand this. That's why you're seeing massive migration from high-tax states to low-tax states. Hedge funds are moving from New York to Miami. Tech companies are moving from California to Texas. Wealthy individuals are changing their tax residency in record numbers. They're not just trying to avoid current taxes. They're positioning themselves to avoid future taxes. But moving isn't enough. You need to understand the residency rules in your new state. Some states will try to tax you even after you move if they can prove you still have significant ties to the old state. You need to establish domicile in your new state, which means more than just buying a house there. You need to register to vote, change your driver's license, establish business relationships, and generally make it clear that you've truly relocated. Now let me talk about some specific strategies you can implement right now to protect your wealth from the coming tax increases. The first and most important is Roth conversions. This is a strategy that's available today but might not be available tomorrow. With a Roth conversion, you move money from a traditional retirement account to a Roth retirement account. You pay taxes on the conversion at today's rates, but then the money grows tax-free forever. Here's why this is so powerful right now. Tax rates are relatively low by historical standards. If you believe they're going up significantly in the next few years, it makes sense to pay taxes now at lower rates rather than later at higher rates. Plus, once money is in a Roth account, it's protected from most future tax changes. They can't easily change the rules on money that's already in Roth accounts without causing a political firestorm. But Roth conversions require careful planning. You want to convert enough to take advantage of your current tax bracket without pushing yourself into a much higher bracket. This might mean spreading conversions over several years. It might mean timing conversions in years when your income is lower. The key is to model out different scenarios and understand the trade-offs. The second strategy is tax loss harvesting on steroids. Tax loss harvesting means selling investments that have lost money to offset gains from investments that have made money. This reduces your current tax bill and allows you to defer taxes into the future. But if tax rates are going up significantly, deferring taxes might not be beneficial. So instead of just harvesting losses to offset gains, you want to harvest gains to offset losses. This sounds backwards, but think about it. If capital gains rates are going to double, it might make sense to realize gains now at lower rates rather than wait and pay higher rates later. You can then reinvest the proceeds in similar assets and reset your basis to current market levels. The third strategy is asset location optimization. This means putting the right types of investments in the right types of accounts to minimize your total tax burden. Generally, you want to put investments that generate ordinary income in tax-deferred accounts and investments that generate capital gains in taxable accounts. But the optimal strategy depends on your specific situation and your expectations about future tax rates. The fourth strategy is municipal bond ladder construction. Municipal bonds are generally exempt from federal income taxes and often exempt from state income taxes if you buy bonds issued by your home state. If tax rates are going up significantly, the value of this tax exemption goes up too. A municipal bond yielding 3% might be equivalent to a taxable bond yielding 6% if you're in a high tax bracket. But municipal bonds aren't risk-free. The issuers can default, and the bonds can lose value if interest rates rise. That's why laddering is important. Instead of buying one long-term bond, you buy multiple bonds with different maturity dates. This gives you more flexibility and reduces your interest rate risk. The fifth strategy is charitable giving acceleration. If you're planning to make charitable donations over your lifetime anyway, it might make sense to accelerate those donations before tax rates go up. This is especially true for appreciated assets. If you donate stock that's appreciated significantly, you avoid paying capital gains taxes on the appreciation, and you get a charitable deduction at fair market value. But charitable giving can be optimized in many ways. Donor-advised funds allow you to make a large charitable contribution in 1 year and then distribute the money to specific charities over time. Charitable remainder trusts allow you to make a charitable donation while retaining income from the donated assets. These strategies require planning, but they can provide significant tax benefits. The sixth strategy is business structure optimization. If you own a business or have self-employment income, the structure you choose can have enormous tax implications. Pass-through entities like S corporations and partnerships allow business income to be taxed at individual rates rather than corporate rates, but the rules are complex and changing. The recent qualified business income deduction allows many business owners to deduct 20% of their business income from their taxes, but this deduction is scheduled to expire in 2026. If you can accelerate business income into years when the deduction is available, you can save significant taxes. Now let me address the psychology behind why most people aren't taking these steps. Tax planning isn't sexy. It's not exciting like picking stocks or buying real estate. It feels defensive rather than offensive. People would rather focus on making more money than protecting the money they already have. But this is exactly backwards. Protecting wealth is often more important than creating wealth, especially when you're dealing with large amounts. If you have $1 million and you lose 30% to taxes, you've lost $300,000. To make up for that loss, you'd need to earn $429,000 before taxes. It's much easier to protect money than to replace money. There's also a normalcy bias at work. People assume that the current tax environment will continue indefinitely. They plan their finances based on today's tax rates and rules. But tax rates change constantly, and they're usually more volatile than investment returns. The difference between retiring in a high-tax environment and a low-tax environment can be worth millions of dollars. Another psychological barrier is complexity. Tax planning involves understanding rules that are constantly changing and strategies that can have unintended consequences if implemented incorrectly. Many people would rather pay higher taxes than deal with the complexity of minimizing them. But complexity is often where opportunity lies. The strategies that require more work are often the strategies that provide more benefit. There's also a political component that people don't like to acknowledge. Many people have strong political beliefs about taxation and wealth inequality. They feel guilty about minimizing their taxes, even when they're doing it legally. But tax planning isn't about avoiding your civic responsibilities. It's about keeping more of what you've earned so you can provide for your family and contribute to causes you believe in. The government has entire departments dedicated to maximizing tax revenue. They hire lawyers and accountants and economists whose full-time job is to extract as much money as possible from taxpayers. You need to have professionals on your side too. You need people whose job is to legally minimize your tax burden and protect your wealth. Take a typical middle-class family with a household income of $150,000. Under current tax rules, they might pay around $25,000 in federal income taxes. But under the proposed changes, that same family could easily pay $40,000 or more. That's $15,000 less per year for everything else. Over 20 years, that's $300,000 in additional taxes. But it gets worse when you factor in state taxes. If this family lives in California or New York, their total tax burden could approach 50% of their income. Think about that. Half of everything they earn goes to various levels of government. Now, let me show you what proper tax planning can do. the same family with the same income, but with proper planning, might reduce their tax burden by 30 to 40%. That's not through illegal schemes or aggressive strategies. That's through legal techniques that wealthy people have been using for decades. For example, if this family maximizes their retirement contributions, uses a health savings account, implements tax loss harvesting, and structures their investments properly, they could easily save $10,000 to $15,000 per year in taxes. Over their working lifetime, that's $400,000. The difference between families who plan for taxes and families who don't isn't small. It's the difference between financial security and financial stress. It's the difference between retiring comfortably and working until you die. Let me walk you through a specific example of how these strategies work together. Meet John and Mary, a hypothetical couple in their 40s. John is a software engineer making $120,000 per year. Mary is a marketing manager making $80,000. They live in a suburb outside Seattle. They have 2 kids and they're trying to save for retirement. Under the current tax system, John and Mary pay about $30,000 per year in federal income taxes. Washington State has no income tax, so they're only dealing with federal taxes and Social Security taxes. Their total tax burden is around $45,000 per year. But starting in 2026, several things are going to change for John and Mary. First, the tax brackets are going to shift, which will increase their federal income tax burden by about $3,000 per year. Second, if capital gains rates increase as proposed, their investment gains will be taxed much more heavily. Third, if Washington State implements an income tax, they could face another $8,000 per year in state taxes. Suddenly, John and Mary's tax burden has gone from $45,000 per year to about $56,000 per year. That's $11,000 less for everything else. Over 20 years, that's $220,000 in additional taxes. But now let me show you what happens if John and Mary implement proper tax planning strategies starting right now. First, they maximize their 401k contributions. Currently, they're only contributing enough to get their employer match, but they increase their contributions to the maximum allowed. This saves them about $4,000 per year in current taxes. Second, they implement a Roth conversion strategy. They convert $20,000 per year from John's traditional IRA to a Roth IRA. This costs them about $4,000 in current taxes, but it protects that money from future tax rate increases. Third, they optimize their investment portfolio for tax efficiency. They move their bond holdings into their retirement accounts and keep their stock holdings in taxable accounts. They implement tax loss harvesting to offset any gains with losses. These strategies save them about $2,000 per year in taxes. Fourth, they establish a health savings account and max out their contributions. This gives them another $2,000 per year in tax savings while building a fund for future healthcare expenses. Fifth, they start planning for potential relocation. They research states with no income tax and begin establishing connections in those areas. They don't move immediately, but they position themselves to move quickly if needed. The result of these strategies is that John and Mary reduce their current tax burden by about $8,000 per year, while positioning themselves to save much more as tax rates increase. Instead of paying $56,000 per year in taxes in the new environment, they pay about $48,000. That's an annual savings of $8,000, or $160,000 over 20 years. This is why tax planning is so important and why starting early makes such a difference. The strategies available today might not be available tomorrow. The Roth conversion window might close. The health savings account rules might change. Let me talk about some of the more advanced strategies that wealthy families use, because understanding these techniques will help you think more strategically about your own situation. One of the most powerful is the charitable remainder trust. This allows you to donate an asset to charity while retaining income from that asset for the rest of your life. Here's how it works. Let's say you own stock worth $500,000 that you bought for $100,000. If you sell the stock, you'll owe capital gains taxes on $400,000 of gain. At current rates, that's about $80,000 in taxes. But if you donate the stock to a charitable remainder trust, you avoid the capital gains tax completely. The trust can sell the stock and reinvest the proceeds to generate income for you. You get a charitable deduction for the present value of the charity's remainder interest, which might be worth $100,000 in tax savings. This strategy becomes even more powerful if capital gains rates increase significantly. If rates double from 20% to 40%, the tax savings from using a charitable remainder trust increases from $80,000 to $160,000. The higher the tax rates, the more valuable these strategies become. The geographic component of tax planning is becoming increasingly important as states face budget pressures. The differences between high-tax and low-tax states are growing every year, and those differences are going to accelerate as federal tax rates increase. Consider the difference between living in New York versus living in Florida. New York has a top state income tax rate of over 10%, plus local taxes that can add another 3%. Property taxes average around $15,000 per year on a $500,000 home. Florida has no state income tax, property taxes that average around $7,000 per year on the same home, and sales taxes around 6%. For a high-earning family, the difference can easily be $30,000 per year in taxes. The estate planning implications of the coming tax changes are particularly important for families with significant assets. The current federal estate tax exemption is over $12 million per person, but that exemption is scheduled to drop to around $6 million in 2026. This means families who never thought they'd be subject to estate taxes might suddenly find themselves facing potential tax bills. A family with assets worth $7 million could face estate taxes on $1 million of assets if the exemption drops. Estate planning strategies like gifting, trusts, and family partnerships work better if you implement them before the rules change. Once the new rules are in place, these techniques become less effective or more expensive. Let me address one more psychological barrier that prevents people from taking action: the belief that tax rates won't actually increase as much as proposed. Many people assume that the political process will moderate the proposals and that actual changes will be smaller. This is a dangerous assumption. The fiscal pressures are real and growing, the debt levels are unsustainable, and the demographic trends are undeniable. Something has to give, and that something is usually taxes. The smart approach is to plan for higher tax rates while hoping they don't materialize. If you implement tax planning strategies and rates don't increase as expected, you've still benefited from the tax savings. But if you don't plan and rates increase significantly, you'll be stuck paying much higher taxes. This brings me to the final point about timing and urgency. Tax planning is most effective when you have time to implement strategies gradually and optimize them over time. If you wait until the last minute, you'll be forced to make suboptimal decisions under time pressure. The window for many strategies is closing. The ability to do Roth conversions might be eliminated for high earners. The current estate tax exemption levels might be permanently reduced. The opportunity to establish residency in low-tax states might become more difficult. Every month you wait is a month of lost opportunities. Every year you delay is a year of strategies that become more expensive or less effective. The time to act is now, while you still have maximum flexibility and options. Your financial future depends on the decisions you make today. The tax tsunami is coming whether you're prepared for it or not. The question is whether you'll be ready when it hits or whether you'll be caught off guard like everyone else. Don't be the person who wishes they had acted when they had the chance. Be the person who saw what was coming and positioned themselves accordingly. Your future wealth depends on it.